So thank you everyone for joining today. This is a regular in our series of webinars. Today we're specifically speaking about accounting and the R&D tax incentive and how they work together. We often get questions from clients, prospective clients, asking what the advantages are of bringing all their services under one roof. And we obviously would recommend that. So this is more tailored to those kinds of clients, potential clients who might still have services spread out across multiple providers. Also for those that are currently self-claiming, we would highly recommend not doing that, not self-claiming R&D, having it done by an R&D tax consultant. This presentation, though, is equally as hopefully interesting for those who do have their accounting and R&D tax services currently with Fullstack. There may be a few things that you haven't realized, some advantages moving forward that we can implement to really streamline the process and improve those outcomes. So as always, you shouldn't take any information in this webinar as specific tax or legal advice. Always contact your lawyer or tax accountant, consultant before making any decisions, putting anything in place. Fullstack, hopefully you're already aware of us, but if not, we're a chartered accounting firm that's been going since 2017, and we're really the kind of one-stop shop for entrepreneurs, the tech sector, startups, that kind of. A lot to talk about today. We'll talk about all these topics, but hopefully kind of race through a few sections just to respect everyone's time here today. So we'll just jump right into it and over to Tanya.
Hey everybody, thanks for joining us today. We often get asked, why shouldn't you separate R&D and tax, and why should you keep them together? So one of the main functions of R&D is being able to get your income and expenses correct. So when you are preparing that R&D schedule, if you don't have everything in the correct place, then it just makes it so much harder to get to the end goal. So what we recommend to get your R&D claim done as quickly and efficiently as possible is to make sure that in the first instance, you're keeping up to date with all of your reporting. So make sure that your BAS is done when they should be done. So if you're on a quarterly BAS cycle, make sure that if you're self-lodging, it's within the 21 days after the period end. So the quarterly periods for BAS, that's March, June, September, and December. And if all of your BASs are lodged as you go, and if you're doing it with, say, someone like Fullstack Advisory, then we will look at it as we go and we will make sure that what you're lodging is correct, so that come year end, you don't sit with a lot of unreconciled transactions, or you don't have a messy P&L and balance sheet that we have to try and sift through. Then after the year end, so I think Jack would suggest from the 1st of July, you would submit your R&D tax application. This doesn't mean you have to wait until then to get your project description and all of that ready. You could do that early. You could have that ready to go, but obviously you'll only have your initial estimate of your R&D expenditure after you've looked at everything. Now, to be able to know which expenses would be eligible for R&D, it is a specialist field, because when you read the legislation, if you don't use the legislation as intended, then you can accidentally claim things that shouldn't be claimed. And the problems, they sort of roll into each other, which we don't want. But we recommend, if you have something that you think is eligible for R&D, that you would tag it, or you would use tracking categories or something similar within your accounting software to specifically notate that you think that this is eligible R&D. Then when someone like Jack is reviewing it, they know which transactions to look at, so that it doesn't become an audit of each and every transaction that you went through during the year. So then after that, after you've done your application, you would get your registration number from Oz Industry. You would calculate the notional, we would calculate the notional deductions for eligible R&D. And it's also important to note that if something is not deductible for tax purposes, it can't be eligible for R&D. That's kind of step one. It needs to fall into the tax legislation first, in the first instance, and then it could be eligible for R&D. And when you get to your end of financial year, there are a few things that we can do to make sure that you have your best foot forward. And basically, the overseas finding application takes a little bit of time to do. So recommend getting that done quite early. Jack can tell you a little bit more about that. And when it comes to associate payments, and those are yourself or any businesses affiliated with you, then it needs to be physically paid before the end of the year for it to be eligible for R&D. The same thing goes for superannuation. So if you have employees, if you're paying someone as an employee, you need to have withheld tax. You need to have paid superannuation on that for it to be eligible for R&D purposes.
Yeah, and so obviously Tanya just touched on that kind of interaction between the ordinary tax provisions and the R&D tax treatment. So bringing those together just eliminates a few issues, sometimes having to go back and forth between the R&D tax consultant and a tax accountant who might have different understandings. Generally, bringing all that in-house will provide a more efficient and potentially beneficial outcome. So, Tanya, do you just want to speak a little bit about the franking?
Yes. So one of the questions I also get a lot from founders is, well, what's the downside of R&D? It sounds too good to be true. Well, you're basically borrowing from tomorrow. And so what's happening is you get the tax credit right now, and which could be refundable, but that also creates a debit in your franking account. Now, your franking account is a little bit like, to explain it at the easiest way that I know how, is it's basically tax paid by the company that can be used at a later stage by the shareholders. So the shareholders can get franked dividends, and it means the tax that's been paid by the company flows through and the credits can be used by the shareholders. If you think about your investments, let's say if you have, say, ComSec investments, then you get the statement and it says you've got this amount of franked dividends and this amount of unfranked dividends. Now, the tax you pay on it is exactly the same, but you do get a little bit of a credit if it's a franked dividend, which is usually the 25%. And what will happen in a profit-making entity is that the R&D tax incentive will reduce the amount of tax that you need to physically fork over to the ATO. So you get to hold on to a little bit more of your cash at that stage. And if you're loss making, you actually get cash back. But then when you get cash back, it creates a debit in your franking account. And when in future, when you do become profit making and there is a surplus retained earning to distribute, then you have to work down by paying tax that debit franking balance first, and then you can start getting the benefit of franked dividends. So it's kind of like you're borrowing from yourself, from your future self, just for tax purposes. And
So a little bit more tax planning, Tanya. Yep.
Yeah. So when you are claiming the R&D tax incentive, that one of the questions that I know, Jack, you get asked this a lot, but it is, what's eligible for R&D? Should I be paying myself a salary? And if you are doing R&D, I think the overwhelming answer there is yes. If you are actively working on the R&D, you should definitely be paying yourself a salary. But there comes a bit of a holistic viewpoint in that as well. Jack, do you want to explain? You explained it so well to me the other day.
So often, sweat equity, as we covered and we'll touch on in the previous slide, cannot be claimed for R&D. That's a very common question that I get asked, because it is not a deductible amount under the normal provisions, because you haven't actually incurred any cost. You can't then claim it in R&D. Now, the question is then, okay, if I want to accelerate my R&D, if I want to recognize the work that I've done, how can I pay myself and increase those R&D refunds, but also how can I do that in a way that's tax effective? And so for founders, often I get a question, well, should I put in $50,000 into the business then pay myself that $50,000, write it up as a loan, and then I can claim 43.5% back of that as R&D. Now, from a holistic perspective, if you take everything into account, you'll have to obviously pay tax on that personally, on that salary. So at the end of the day, you're spending $1 of your own money to pay yourself back less than $1 to get back 43.5% of that dollar. So sometimes it doesn't really make sense to do so, looking at everything holistically. On the flip side, obviously, if someone else is paying your salary, then yeah, let's go. If you have made a big round of investment and it's an opportunity to start paying yourself, then you take that investment, you pay yourself that salary, make sure that it's set up correctly, you're paying super, PAYG, etc. And then you can go ahead and claim that 43.5%. And then that's where it actually does kind of accelerate that development and lead to effective tax outcomes. So bringing that all in together, having a team that's more of an advisor rather than just a form filler coming in once a year for the R&D, coming in quarterly for the BAS, and once a year for the tax return, having someone that can be a bit more proactive in their approach, work, often with the CFO directly, just to set up everything and make sure that when it comes into the end of the year, that everyone's kind of comes out ahead rather than having these strange adverse tax outcomes. There are a number of that's just one example of that kind of holistic advice. There's also things like, okay, how do we deal with depreciation? Over the years, there's been a lot of different programs, some that interact favorably. Instant asset write-off does not act favorably with the R&D tax, whereas the temporary expensing provisions that we've been using for the last few years do work well with those. So again, having someone that has a very overall view of your whole situation and can advise accordingly to make sure that R&D is being accelerated. There are many benefits of aligning the tax and R&D tax because of that kind of ongoing, making sure that the BAS are on time, making sure that the accounts are as final as can be for 1 July, making sure that the R&D aligned is that. It can lead to faster claim preparation and quicker receipt of those refunds. There is that ability to provide that real-time advice around expense items, things like that. Superannuation, PAYG, we've touched on already. I think something that is sometimes missed as well is where those two functions are separate, the kind of technical side of the R&D claim, let's say done by the R&D consultant, and a financial side done by an accountant or potentially done by the client themselves, where those are not done by one person or one team, they can become misaligned because the financial side is directly related and necessitated. It's based on the technical side. So separating those functions can lead to situations where you're either overclaiming or underclaiming, where our approach is always to claim the correct amount, the actual amount incurred on R&D. So having one person that is kind of on top of all that leads to, can reduce that risk and lead to those better quality claims. At Fullstack, we do save on some of those efficiency. We pass on some of those efficiency savings through lower fees. And also potentially, if those functions are separate, you won't be able to access R&D Finance, or that process might become a little bit more complicated and just take a little bit longer. And I'll touch on that further in a second. So where this misalignment comes in often is in the R&D tax schedule. So where one person does the technical side and one person does the financial side. My view, someone who does both, is that they should definitely be done by the same person or the same team at least. Very, very often where we schedules prepared by other consultants, particularly there are some out there who provide kind of technical services, preparation of application forms that aren't registered tax agents under the TBB. Now, that's not allowed, but I think it doesn't lead to very good, high quality claims. And where people self-claim, where they prepare the schedule themselves, there are 9 times out of 10, there are errors in the R&D tax schedule, which means that we have to go back, waste time, waste effort from both kind of sides. And it can often create quite a lot of frustration for people who want their refunds to come as quickly as possible. So again, aligning that the preparation is much more preferable. Just a few things there. Aggregated turnover is a big one. Associate payments are not taken up correctly. Overclaiming severely sometimes for associate payments, which could lead to very adverse reactions down the road. Clawback in feedstock is typically not understood by people without specific knowledge around the tax legislation, and so they're often incorrectly treated. So the R&D Finance, for those of you who aren't aware, R&D Finance is a product, a loan essentially, where a company a finance provider will loan you generally up to 80% of your refund that will come in at the end of the year. Generally, to minimize the risk of that loan, the R&D finance providers work with a list of approved consultants. Fullstack are obviously one of those. So those approved consultants will assist companies determine what is eligible and how much they can claim, how much they've spent on those R&D activities, and they will do a calculation maybe once, twice, 3 times, 4 times during the year, provide that letter to the finance provider, and then the finance provider will provide that loan. There are a number of things that are also required from an accountant. So a letter of comfort, the previous company tax returns, generally that would come from the accountant rather than an R&D consultant, and just some reports from the ATO, things like that. So again, bringing everything in to one provider, one accountant / R&D consultant, means that process is just a little bit quicker and a little bit easier. There's not as much back and forth. So there's some other advantages, mostly covered these, but I guess engaging with an R&D tax consultant / accountant that is really specialized in tech. Fullstack, as I said at the start of the presentation, we are the kind of one-stop shop for startups, software claims, that kind of area, and our kind of better understanding of the technology behind that, or our experience with the hundreds of clients over the years, means that our financial calculations are more accurate. They're more defensible if you ever do get audited, because we understand what the cost drivers of hosting and subscription and all those things are, rather than just doing the kind of old school methods of apportionment of overheads, for example. There are also opportunities to do more real-time tracking of R&D expenses, like Tanya mentioned towards the start of the presentation, having those regular check-ins and being more of an advisor, an ongoing advisor rather than just a once-a-year kind of form filler. There are also other programs like grants, the ESIC incentives as well. Just bring everything in together with the R&D consultant, with the tax accountant, means that we can provide those services much more efficiently. So there are our contact details there. You can pretty much just book a meeting with any of our team members whenever you want. We're very kind of open with that. So please feel free to get in touch with us if you have any further questions. Please feel free to reach out to us via those channels on the screen. Thank you everyone again for attendance at this webinar. Hopefully it was informative. Thank you.
Bye.